But more importantly, he is a Brazilian Jiu-Jitsu blue belt, and he's also one of the founders of Blocktower Capital. Everyone, please join me in welcoming Ari Paul.
Test, test. Hello, everyone. A little background on the blue belt thing. Mikhail and I became friends partly through jiu-jitsu. Mikhail was a white belt at the time. I unfortunately was forced into retirement from an injury, but Mikhail's been, you gotta watch your knees and ankles carefully. There's a lot of leg locks in that sport. UPenn is my alma mater, although not, I spent very little time in the Death Star. I only had a couple classes here. I was a poli-sci major, and that's actually turned out to be somewhat applicable. For those of you who were here last year, I gave a talk last year, and I'm probably going to repeat about 20% of the content, because I hate repeating myself, but I think it's just super applicable to this audience. But I promise there'll be some new stuff too. I'll start with some very practical kind of real-world advice. I'm assuming this is an audience of people, I know many of you are already in crypto in one form or another, but many of you are interested in getting in or going deeper, or maybe you're doing an internship or something part-time and you're thinking of making a career out of it. So the first half of the talk will be trying to be practical and helpful from that angle, and then the second half will be a little more philosophical and rambling and the stuff I like to kind of geek out about in the crypto space. So I'm going to start the talk exactly the way I did last year, which is cryptocurrency, no one owns any, and no one uses it. So that's kind of where we are today. So no one owns any. The real numbers are probably something like 35 million people in the world own cryptocurrency. That's a rough guess, but it's not that far. Maybe the real number is 60 million, maybe it's 25 million. It's somewhere between 90 and 70 million, almost for sure. And that's tiny. That's almost trivial. That's less than 1% of the world's population. And no one, even fewer people use it. So most of those people who own cryptocurrency own it passively. They own it for speculation. They own it, they created a Coinbase account, they bought some Bitcoin, and they don't do anything with it. If we talk about usage of cryptocurrency for anything other than speculative purposes, you're probably looking at less than 1 million, maybe 2 million active users. And that includes things like darknet purchases, a game based on Ethereum or Steam, the Ethereum decentralized finance stack. So this is an incredibly tiny niche industry with very little real usage and real adoption. And I say that not to be pessimistic. To me, that's a very optimistic statement because that's how early we are. This is, I get asked this a lot less frequently, but at the end of 2017, for example, people were saying, is it too late? Is it too late to invest? Is it too late to get into the industry? And it's just so incredibly early. A debate that some people in crypto will have, I wrote an essay called It's 1994 in Cryptocurrency in 2017, and I have some smart friends who said, no, Ari, it's 1988 or 1985. It's, I was being kind of too aggressive in that analogy. So it's incredibly early, and with that earliness comes a whole smorgasbord of challenges to anyone in the industry. So there's very little infrastructure that's been built. This was kind of why I used 1994 as an analogy. In 1994, you had kind of the first explosion of websites. You had e-commerce sites, you had video streaming sites, you had most of the websites, most of the use cases we know and love today on the internet existed in 1994 in some form, and almost all of them failed. So you couldn't do video streaming in 1994 because whoever was on the internet was on AOL dial-up. You couldn't do e-commerce because only 1% of the world had internet access, and very few of those people were comfortable entering a credit card. You couldn't do, so you had these infrastructure constraints like bandwidth, like credit card payment processing being integrated. You had consumer behavior constraints. People didn't trust the internet with entering credit card information. You had to build almost everything from scratch. So you didn't have tech stacks that you could just plug into and snippets of code that would make things very easy. So there were a lot of very cool, sexy projects and companies that launched. Most failed because the infrastructure wasn't there yet, the consumers weren't there yet. In many ways, that's comparable to where cryptocurrency was last year and still is today. Much of the last year was kind of the quiet building of infrastructure. The prices have been actually relatively flat over the last year. It's been a bear market, altcoins have sold off a bit, but the market as a whole actually hasn't moved that much from a price perspective. What's been happening is kind of this quiet underlying attacking of all of those problems. And this is the single mental framework I would suggest if you think about entering the industry. which is all of those reasons that are legitimate reasons why cryptocurrency can't be used today. Whoever solves each of those problems, that's a billion-dollar company. And that was true in the tech boom. So in 1994, you'd say, you can't do a video streaming site because there isn't the bandwidth, there isn't the consumer behavior and trust, it's too hard to do credit card processing, it's too hard, each of those things then became a billion-dollar tech startup. So very similar in crypto, I can kind of dive into some of the challenges. So I run a crypto investment firm. Things are getting a little better right now, but as of 6 months ago, we had to trade using trading software we created in-house because there were almost no off-the-shelf trading tools. Nothing that was an institutional trading caliber even close. We had to self-custody our assets. That means I can steal the cryptocurrency that we custody for our clients. That wasn't by choice, that was because you did not have trustworthy third-party custodians. Today that's changed, there's now a few. None of them are quite institutional quality yet, but we're getting very close. Fidelity is going to be launching a Bitcoin custody solution. It's already soft launched, they have a handful of clients, they're going to be rolling that out at scale. Their security solutions are stronger than intelligence agency grade. The challenge in the space is custody of stock certificates is very, very simple and easy. Right? It'd be very hard to steal $1 million of Microsoft equity up with physical stock certificates. It's traceable, it's hard to get away with. With cryptocurrency, it's a very easy thing to steal, it's a very easy thing to launder. And so security is really important. We usually don't think about State Street custodial security. Here it actually matters. So Fidelity's done a wonderful job creating a really next-gen security solution. They have a few competitors. But they're all kind of soft launch, they're all in beta. So that's still very much a blue ocean. I mentioned the trading software. There's a lot of people trying to build the Bloomberg for crypto. No one's done it yet. So, blue ocean there. There's a lot of different kind of angles to the scalability bandwidth concern. There's innovation at the protocol layer, so there's improvements happening to Bitcoin and Ethereum. There's also innovation as a service. So, for example, there are companies being created that create a separate internet for miners to communicate block solutions to each other, which improves each of their profitability at the margin. But the margins matter here when it's very competitive. So the single piece of advice I would give you, kind of practically speaking, is this is such early stage that tackling the big problems makes sense. If you were going to get involved in tech today, you probably wouldn't join a startup that is trying to recreate TCP/IP or trying to replace FTP, right? That's so ingrained, the internet is so mature that everyone who is leaving Wharton to go work at a tech company is probably working at the high application layer. They're probably working on onboarding new, as a product manager at Google or Facebook. At cryptocurrency, I think that's a mistake. We're not ready for it yet. The projects that tried to do that 2 years ago, most of them have already failed. I still think it's mostly too early. And so think about the big problems. What is preventing cryptocurrency from having 100 million daily users, 1 billion daily users? Those problems, I think, over the next 5-10 years will be the ones that get solved and create those first wave of billion-dollar firms. The application layer, we'll see, I hope, the first set of killer dApps, killer decentralized applications in the next 2 years, but they're likely to be reserved to a few very simple niche opportunities, which I'll maybe get into a little bit more later. I'm looking at my phone just because I have a few notes for topics to talk about. I'll give a kind of quick overview of the state of the industry as a whole. So geographically, cryptocurrency is pretty darn geographically diverse. I think of the leaders in crypto as mostly the US, Japan, China, and South Korea. Europe certainly is doing a lot, kind of in aggregate. South America, we're seeing a lot of growth. In the last year, South America was probably one of the most exciting, fast-growing kind of user adoption cases, but it's still relatively small. On the regulatory side, you have true diversity. So South Korea, Japan, and the US are each doing things quite differently. China is kind of its own little world in that regard. That there was a panel that I was just watching of China experts, so it's really not my place to kind of try to weigh in on that, but China is certainly the most opaque. With all of the others, you can kind of take it at face value. So in the US, regulation is fairly simple, which is to say the only question is something a security? If something's not a security like Bitcoin, there's almost no regulatory ambiguity. We kind of know the AML KYC stuff that it might fall under. You don't need to register it. Secondary sales aren't regulated by the SEC. So we have pretty good clarity, and basically if something's not a security, there's very little to worry about. You handle it like gold, and it's pretty simple. All of the complexity and argument and debate around regulation in crypto today, or almost all of it, is around what is and is not security, which really has potentially very little to do with crypto. I think the way that's going to play out is the SEC is deliberately dragging their feet. They don't want clarity. Clarity produces growth, and the SEC is kind of scared of crypto and what might come with it not in a bureaucratic sense. So the thing that drives the world are individual incentives in these bureaucracies. And so an individual bureaucrat at the SEC doesn't want to almost accidentally have their name on a cryptocurrency boom that could do things, could produce outcomes that they can't expect, and that could be reputationally damaging. So the SEC, I don't expect meaningful clarity in the next year. Probably we'll have to wait a few years for that. We'll probably get some new legislative proposals that redefine the security laws that apply here. And then we're going to have some really interesting court cases. So there was a great essay in 2016 by Joel Monegro, who was an analyst at Union Square Ventures, called the VAT Protocol Thesis. It's a very, very short essay. It's literally 1 page long. If you Google search VAT Protocol Thesis, VAT Protocol Hypothesis, you'll find it. And Joel argued that the value of cryptocurrency will accrue to the base layer. I joked that I predicted for 2019 the fat lawyer thesis, that probably the single biggest growth area in crypto was litigation, because a lot of these ICOs are going to be sued by their investors or sued by the SEC. You're going to have exchange failures and lawsuits, you're going to have market manipulation lawsuits. So if you're a lawyer by training, I actually think crypto law is a massive growth industry and will be for the foreseeable future. And I don't mean that jokingly, and I'm not terribly happy about it as often as having to support those lawyers to navigate the regulatory landscape. But that's a huge growth area, and it's going to remain ambiguous for quite a while. Let's see, what other key segments do I want to touch on? So I touched on on the custody side, I think we're probably about 6 months away from it being fairly consensus that there are decent custodial solutions. I don't think they'll be State Street level. A pension will still have real trouble trusting them. But your average global macro hedge fund will feel comfortable with Fidelity and probably feel comfortable with a few of these others. Family offices, wealthy individuals, there will probably be strong enough custodians that people will trust them. Some of that trust comes from brand, so the Fidelity brand obviously carries a lot of weight. Some of it comes from intermediation of risk via insurance, so all of these custodians are getting insurance. In other words, people are not going to trust the technology. Here's an interesting question I get asked a lot. Basically, how do I trust the cryptography? Or how do I trust the hardware security models the custodian says they're using? Or how do I trust the entropy generated? Or how do I... And the answer is that's not how life works. We don't trust our cars because we've analyzed the internal combustion engine. We don't trust plugging a credit card number into Amazon's website because we've evaluated the code. We trust based on reputation and familiarity. That's just how life works. So the same with institutions. We don't... 90% of Wharton is not a detailed evaluation of what Wharton is. We're familiar with the brand. We are familiar. It's trust in the institution in kind of an existential sense, which comes from time. So most people will not be evaluating custodians or cryptocurrencies technically. 8 years ago, if you wanted to pitch someone on Bitcoin, you had to convince them to trust SHA-256, which is the encryption algorithm. You had to convince them to trust proof of work, which is the consensus mechanism. Today, it's worked for 10 years. And that's kind of how we generally trust institutions and technology. We trust our cell phones not because we understand the tech, but because, hey, they worked yesterday, they worked 3 years ago, they probably work. So a lot of the function of trust in cryptocurrency and trust in crypto institutions improving is literally just a function of time and lack of failures. So what can be devastating for the industry is when there's extreme explicit failures like a massive exchange failure, because that legitimately makes us wonder what other exchanges might be vulnerable, and it causes us to realize we don't even know how to evaluate it. So a terrible scenario would be if a leading custodian has a security failure, that's a real problem because then everyone will say, wow, we don't even know how to evaluate custodians. If that doesn't happen, you just kind of build up trust over time. So I guess the point I was trying to make there is timing on custodialship, I think, is 6 months out. Maybe it's easy to be too optimistic, so maybe I should say 12. And it will be a function of time, the way you hear other investors talking about those. So someone with a pension might still be 2 years away from trusting it because they'll want to see it up and running for a couple of years. That would be the proof to them, not a detailed evaluation of the hardware. On the trading side, there's a very small number of meaningful crypto funds. There were a lot of headlines that like 100 crypto funds, 200, 300 launched. Most were $5 million funds run out of a 25-year-old's apartment. And even that $5 million was because a lot of people got rich in 2017. You had a lot of 22-year-olds who bought $20,000 worth of Ethereum and suddenly had $1 million. And you know, a couple friends would give them money, but these were not funds in kind of the way we would normally think of them, even though they might have been really, really smart investors. It's a very small number of crypto native funds, meaning funds that are fully primarily devoted to crypto. Probably something like 30 in the US is a reasonable number, and even there, they're tiny. So we're talking generally, the average, the median AUM of those 30 is probably something like $25 million. There's only a couple, more than a couple, but less than 10, less than 6, over $100 million. So it's a very small professional investing landscape. It's grown pretty quickly. So actually, my last statement neglected, we have 2 VC funds launched, a spin-out of Andreessen Horowitz and a pseudo spin-out of Sequoia that are now crypto VC funds run by very talented managers. They each raised about $400 million last year. The first pensions invested, so there's one fund that got a couple pension investments, which were the first time pensions had gotten in the game. Endowments got in the game indirectly by these VC funds in the middle of last year. Just trying to paint kind of a high-level picture of where we are, which is that institutional investors have taken the first small steps towards investing, generally kind of the way you'd expect. They did it indirectly via very, very trusted brands, right? They're not investing in crypto, they're investing in the next Andreessen Horowitz fund, which is, you know, instead of evaluating crypto, you're simply kind of trusting the brand, reputation, the people there who you already have a pre-existing relationship with. On the tech side, as an investor, it's pretty brutal still. So most exchanges do not have fixed API connections, which is the standard in traditional finance. They have these offered custom API connections that means that any fund has to basically write custom API connections to every single exchange they want to connect to. The exchanges are extremely amateurish. Even the big brand name ones are quite amateurish. Nothing like the kind of transparency, tax, I mean, even for example, Coinbase doesn't provide accurate tax reporting, for example. And Coinbase is one of the leading institutions, one of the more professional. There's a massive wave of new exchanges and new trading software platforms that are in different stages of launching. I think probably they're still 6 to 12 months away from having a meaningful impact, but that's both a huge obstacle to particularly people like algo traders, high-frequency traders, currently, but kind of rapidly improving. I think we're probably a few years away from the exchange and trading side looking anything like traditional. But we'll be moving there this year, towards the end of this year, I think, with some, we'll have some traditional exchanges launching. For example, there are projects by former NYSE chairman, former ICE, which is a giant commodity exchange, senior people who are leading those exchanges to launch crypto exchanges and bringing their technical expertise, their operational efficiency, their regulatory compliance with them. It is a long, slow process to launch an exchange, though, and the regulatory side is pretty painful. It's generally taking these exchanges 6, 12, 18 months to get SEC approval. So a question of where in crypto might be the right place for you. So I'm not a cryptographer and I'm not an engineer, and I try never to pretend to be one. When I first looked at cryptocurrency, I thought I have no business being an investor in the space because I'm not technical. What I came to realize is basically no one has all of the relevant areas of expertise. I've met literally, I have one exception in mind for this, maybe one person who is reasonably competent at most of the areas. But what I found was you had some brilliant engineers and some brilliant cryptographers who were investing in the space. And they're not traders, they're not portfolio managers, they're not risk managers, and similarly on the investing side. These are also usually network effect driven assets. And so things like the psychology or sociology, the marketing is a huge element of it. There's the VC investing side. So if you're investing early stage in these projects, you have term sheets, you have SAFT agreements, you have the actual structure of the investment matters. There's a game theory and economic side when we talk about the value of a token based on the token economics, literally what do you have a right to? And that's something that a traditional portfolio manager or trader in equities is not used to thinking about. And then you have the technical side from many angles. So something that's fascinating to me is I'll see one leading blockchain engineer criticize another for a lack of background in, say, distributed systems. So I kind of lump basically I kind of lump the technical skills in engineering and cryptography, but that's of course comically superficial. You don't even have many people who are fluent in all of the necessary engineering concepts. So all this is to say, it's a very complex kind of nuanced field where you should not let your lack of expertise be an obstacle. Almost everyone should have imposter syndrome. A lot of the people in crypto are pretty young and arrogant, maybe don't, but we kind of all should, because none of us are really competent at all of the necessary fields. We all generally come in with some skill and then try our best to round it out with advisory relationships, expert networks, which are usually informal. I don't need formal expert networks. This is a tiny industry, so the way this works functionally is almost everyone in cryptocurrency is very frequently talking to many other people. You don't have large firms. So most crypto funds are 10 people. Most, even the exchanges are often 50 employees. So very few, you don't really have institutions that are integrated. A crypto fund will have great expertise on a cryptography fund, but maybe is lacking on use of derivatives. So funds talk to each other and share expertise, and exchanges talk to each other, and investment banks talk to each other. Much more so than in traditional markets where, within Goldman Sachs or Morgan Stanley or Bank of America, these are almost like small countries that have, such gigantic workforces and such broad expertise. They don't need to talk to other firms. They don't have such glaring gaps in their ability. So my main point of saying this is don't be discouraged if you feel like you're missing key pieces of expertise. It's extremely likely that you have a skill that it will be in demand. And this is such a young industry that if you're hungry, curious, and work hard, you will very quickly round out your skills to at least a layperson competency, right? So you might not become a cryptographer, but you don't need to. You'll get to the point where you can understand the critical cryptography concepts as applied to your role as a product manager, fundraiser, COO, whatever kind of role. So on that note, this is probably more common at this point. There's been an underappreciation in cryptocurrency for all of the non-technical skills. So the Bitcoin developers, almost since the start, and even true today, they almost have an attitude of, hey, if you can't use a command line interface, we don't care about you. And I had a debate recently with a bunch of cryptocurrency people where I was claiming that, I don't know what, maybe it was MakerDAO CDPs or some other tool that people use. I was saying this is too hard to get adoption. And they're like, Ari, you're an idiot, there's already 1,000 people using it, it's easy, I just did it in 5 minutes. And what they're talking about is basically using the command line interface. So yeah, it's not rocket science. Yeah, there's a lot of 14-year-old kids who can do it, but your grandma's not using a command line interface, and realistically, most of the people in the room, that's a huge amount of friction that you probably would be discouraged, right? So the furthest example is currently in cryptocurrency, almost every platform requires, if you want to transfer it, you copy and paste a public key. The public key or public address is an alphanumeric string, a bunch of letters and numbers. That is enough to prevent adoption. We will never have even a quarter of the world using cryptocurrency if they're copying and pasting an arcane look of alphanumeric strings. And that's fine. It's pretty easy to abstract a string into a handle, a username. But I think a key thing, sometimes there are people like, someone like a Nouriel Roubini, world-class economist, world-class crypto troll, who will say things like, hey, cryptocurrency's been around 10 years, no one uses it. Well, because we're still kind of at the command line stage. We haven't abstracted those things. We have not tried to make it easy for end users yet. That kind of taking a rough product that is sound in an engineering perspective, but lacks features and is almost unusable, is where we all come in. Where, I think things are at a point where one of the major obstacles, or let me phrase it this way, it wouldn't have made sense to focus on abstracting public addresses 8 years ago because the engineering wasn't there yet. You didn't even have a product to simplify. You hadn't yet built the thing you then wanted to make consumer friendly. So there is still a lot of work left to be done on the infrastructure side and the cryptography side and the blockchain engineering side, but we are at the point where one of the major obstacles to adoption is user interfaces, customer service of companies, product design, go-to-market strategies, identifying product market fit. Basically, a lot of crypto projects could use a good McKinsey consultant, to come in and it's amazing. I invest in early stage projects often, and it's amazing how often the team literally has not thought about product market fit at all, like zero. Like well, we built a blockchain that is more private in this way. And I'll say, great, who do you think wants to use that? Crickets, like literally not considered the question. So this is still a very engineering-focused community that underappreciates the critical role of all of the skills that are taught in this building. Marketing is critical, which in this case can also include, it is much harder because there's kind of an educational component. You're not just telling people your product is better, you often have to explain what it is, even a concept, you can define terms. And then just frankly, just all of the business rules. So most companies, you look at Coinbase, I'll use Mt. Gox as an example. So Mt. Gox was the infamous exchange that failed in 2013. It stood for Magic the Gathering. It was run by a guy in his, I guess, mid-20s at the time. And it was a team that was just totally out of their element. They had intended to run this little tiny exchange for Magic the Gathering. Out of nowhere, it really, almost despite their best intentions, it ballooned into $1 billion Bitcoin exchange. Cryptocurrency is the easiest thing to steal. It requires the absolute highest security standards. And suddenly they had this massive amount of consumer interest, and so they do customer support. And they didn't have anyone who knew how to run a business. They didn't have a COO, a CFO, a CEO. So all of those kind of business roles are critical in most crypto firms, whether it's an investment firm, a firm like Coinbase, even engineering-focused firms need a CFO. So I think huge amounts of opportunity. So let me be a little more specific. Just checking my time. Well, I've been on this topic for a while. I'll wrap it up and get to more interesting things. So specific suggestions. The crypto investment banks, the ones that were around in 2017, are almost all shut down or shutting down because they almost all violated regulations. They weren't bad people, they didn't necessarily do anything unethical. It was almost impossible to be regulatory compliant with the ICO price because most of the ICOs were unregistered security offerings. You basically couldn't be an investment bank in 2017 and keep your hands clean. There's a new wave that are not tarnished by that some are up and running, I'm sure more will be launching. That's definitely a growth area. As I mentioned, the legal side, accounting and tax is a huge growth area. Custody, trading software, exchanges, data provision like Bloomberg. These are probably the immediate use cases that will see growth in the next 2 to 5 years. Everything beyond that starts getting probably a little bit more speculative, and getting adoption is probably going to be a little bit tough. I recommend against. There's now 12 businesses I'm aware of that are providing staking as a service. So there's some cryptocurrency networks, you can't stake Bitcoin, at least not natively on the network. If something is proof of stake, like Ethereum is planning to transition to, like EOS, like Tezos, you can stake and earn something like a dividend. Staking can be very technically difficult, and so it makes sense to outsource. So there's 12 firms competing for that business. The ones I'm familiar with are run by great people, very, very smart technologists, pretty savvy on the commercial side. It's very hard for me to see in the next 3 years that being meaningful end user demand. I won't go into all the details of that, but basically I think they're going to have great businesses that certainly will not need VC investments because they're too early. It's a little bit like building a search engine in 1993, when almost, you don't yet even you barely have a web browser. The time for the search engine was really more like 95. The time for online video streaming, you really needed to wait until 1999 or later until there was the bandwidth. So staking as a service, my guess is it's probably a little too early to be a scalable business. It may be defined as kind of two, 3 people. I'm going to try to be a little more succinct. So I find the idea of contrarianism really interesting. Everyone claims to be a contrarian. It's kind of sexy to be a disruptor. If you're in Silicon Valley, you're a disruptor. If you're on Wall Street, you're a contrarian. Almost no one is. Everyone wants to disrupt in the way everyone else is. Everyone wants to be contrarian the way Benjamin Graham and Warren Buffett taught them to. There's a personality contrarianism streak. Do you like arguing with people? Do you like kind of going your own way? And then there's the literal contrarianism in kind of an investment sense. Cryptocurrency is very helpful if you're both. This is still, we're almost getting to the stage where people are asking for the cryptocurrency playbook and the danger. So MBA students generally tend to chase the right career path as of 20 years ago. So what happens, I think, is in 1960, probably the best career path you could have in America was trying to rise to the upper ranks in General Electric management. People wanted to be senior management. That was the sexy thing. That was what, if you were really smart and business oriented, you aspired to. And that made sense. And that was one of the most lucrative career paths you could have. And then basically people see that, they want to achieve that, they want to be the next Jack Welch, they say, what did he do? And they're like, okay, I gotta work my way up in a giant conglomerate, I'll get a degree, I'll specialize in that, I'll intern in that. The problem is by the time you get mid-career, so let's say back then people would get out of MBA in 25, 26, now it's more like whatever, 30. But the problem is you get out, so you start your MBA program, you have a few years doing that, maybe 2 years if you're part-time, a little longer. You get out, you then have a few years of climbing the ladder to get to the point where it kind of matters where you work. And at that point, you've skated to where the puck was. And I probably very few people in this room, it's certainly not the sexy thing to aspire to upper middle management at a conglomerate today. Not saying it's not great, not to try to disrespect anyone, but the majority of MBA classes now look to go into finance or consulting. That pattern, I think, be wary of it. Why does that happen? Because I'll connect this to investing. I think it was Benjamin Graham who wrote that the value of an equity does depend almost entirely on its future cash flows. We shouldn't really care about the past. The past in and of itself is irrelevant. We shouldn't even really care much about the present. The current profits or current revenue of the company is usually a trivial portion of the full value of the equity. And yet, people like Benjamin Graham and Warren Buffett and most analysts really focus. They focus on this quarter's earnings, they focus on the past. Why? And Benjamin Graham is arguing that that is entirely rational. So even though we know it's the future that matters, not the past, we focus on the past because it's what we have. We don't have data on the future. We can't quantify. You can't have grad students in finance get their degrees by doing analysis on the future. So what we get is, on Wall Street, you have all of these quants calculating historical correlation out to 18 decimal points. Because you can do a lot of rigorous work on that, right? You can publish peer-reviewed papers, you can invent new models, you can get degrees in advancement, and there's a lot of meat to sink your teeth into. Whereas if I ask the question, what is the correlation next year going to be, and I don't want you to point me to any historical data, that's a separate project, it just becomes a conversation, right? It's kind of a subjective discussion. So beware of that in yourselves, including in crypto. So you're contrarian by looking at crypto, and I'm kind of giving you some advice that is a little bit stodgy, right? I'm kind of suggesting these infrastructure projects, but in 2 years that might be totally wrong. Maybe that's skating where the puck was, and I think thinking really critically about, look forward. And part of why that's so important here is it's so fast moving. Typical business cycles, I don't know, maybe 7, 8, 10 years, depending on what regime you want to look at and what study. In cryptocurrency, we've generally had roughly 2-year cycles, 2-year market cycles, 2-year industry cycles. Those cycles will probably expand, but probably gradually. So we're probably in for a series of tight, quick cycles that lead to regime changes, that lead to new areas that are the sexy career, the sexy product, the sexy area to be looking at. The right trading strategies, the right investment strategies will probably be changing much faster than in the traditional world, where they tend to change. Venture capital investing only really became a thing in the 80s. Basically, the cycles in traditional markets, in all regards, are just much longer. So you don't need to be as careful about your timing. Whereas in cryptocurrency, for example, the 2017 ICO craze will probably never repeat in that exact form. And if people try to bring it back, it'll probably be a terrible set of investments. It will repeat in some new form. And one thing I spend a lot of time thinking about is what will that new form look like, and how do I take advantage of it, and how do I avoid blindly trying to repeat 2017 successes in ways that will probably not apply? So I think really forcing yourself to proactively think first principles, where does this industry have to lead? What doesn't exist today that can exist in 5 years that I can help build, will be critically valuable. One last comment kind of along that same thread. This is, I think, pretty rare in life, and certainly for people like us who are looking at a fairly narrow set of opportunities. Not many of us probably consider being fishermen or farmers. It's rare to have a new asset class in a new industry, and rare to have one that suddenly becomes big enough for a conference like this to make sense, and for Whartonites to be interested. To me, that was incredibly appealing. As a trader and as an investor, the opportunity to have to explore a new asset class that doesn't have a PE ratio, where we have to define it. Literally, it's, I don't want to say myself because I probably won't add anything meaningful, but it's people in my position today who are literally going to be defining the PE metrics because they don't exist, they're hotly debated. You have a handful of people putting forward metrics, many of which then get debunked and get improved and get tweaked. But this is a little bit like investing in equities, I think, like maybe in the 1920s or the 1930s, which is incredibly intellectually stimulating. Same with if you're a quant, you're dealing with both data science issues and strategy issues. If you're a coder, you're dealing with challenges that are novel, that are changing way faster. So if you're good at following a rule book, if you're good at kind of identifying what people successfully did before turning it into a rule book and following it, it's probably the wrong industry. There's probably industries that will be more rewarding at that. If you were looking at something like being a, let's say, quant arbitrager, and you're like, okay, that seems pretty boring, there isn't that much creativity there, maybe think about applying your skill sets here. Same with law, so maybe you're fascinated by law, but the idea of being a commercial lawyer, kind of trying to not make mistakes, maybe that kind of feels like stifling. Well, in crypto law, you're literally helping write the laws, literally. So there's probably a dozen prominent crypto lawyers, and they're meeting with the SEC every week, and they are providing their opinions on every bit of regulation and legislation, and it's being seriously listened to, because it's literally about a dozen legal minds that are shaping the regulation, the laws, and the judicial judgments. Which to me is an amazing place to be intellectually, from a curiosity perspective, and from a financial perspective. Obviously you're taking a lot more risk. You're taking the risk that you may make wrong bets. You're betting not just with your decisions within your career, but you're betting with your career. But that's potentially incredibly lucrative. I'll end that thought with this kind of example of that. As of a year ago, almost everyone in crypto, sorry, that was my clock for going to questions, so I'll finish this thought. As of a year ago, almost everyone in crypto was B tier by traditional standards. So the people running funds were not Stevie Cohen or, I don't know, pick your favorite idol, Seth Klarman. It was people like me, people who were mid-career. The law firms that were in the game mostly weren't the biggest white shoe law firms. A year ago they started getting in, but 2 years ago, 3 years ago, it was a couple C-tier law firms that would touch crypto. Same with auditing, same with accounting. Now we have all of the bulge bracket law firms, or almost all, and accounting firms are eager to serve us, to do our audits, do our accounting. Same in marketing. You had young D-list marketers. Now you're getting Ogilvy Mathers getting into the marketing game. Partly that's been a function of money. It's a bigger industry. There are bigger checks to write. Partly it's a function of legitimacy. So the incumbents always wait for someone else to take the risk, and then they play catch up. That is I'm using that as a little bit of a self-deprecating line, kind of being honest about the place I was in launching crypto, but that was part of why it was so attractive to me. So, okay, I'm in traditional finance as a trader when I was a little younger as an investor. Can I launch Citadel against Citadel? Citadel was launched by Ken Griffin in his college apartment before you had a Citadel, before you had people doing convertible arbitrage at scale. I don't know if it's possible to launch Citadel doing Citadel today. If it is, I'm probably not the guy who can launch it. So here we still have this blue ocean. You are getting increasingly skilled, competent, capable, senior, mature people entering the field at a very fast pace, but it's still early. So this is still a place where you can climb through the ranks for 20 years in a non-crypto career, or literally in 2 years you can be at the front of this industry. That's a bet on the industry, it's a bet on the asset class, it's a lot of risk, but it's a tremendous opportunity if you're ambitious and thinking entrepreneurially. Let me see if I don't want to say anything else before we go into questions. I'll end with a little bit more of I don't want to say a personal note, but a little bit less objective, I guess. What are we here for? So I will tie it to a technical topic. You may hear a common phrase is blockchain, not Bitcoin. And bankers will say that, or IBM will say that, and what they mean is the technology is really interesting. Bitcoin as a decentralized, scary, potentially criminal thing, not so much. Not only is that wrong, I actually will take it even further. So blockchain is really boring. Blockchain was pseudo-patented by IBM in 1972. There's like 14 IBM patents over 30 years on all of the components that go into a blockchain. Blockchain is literally just a type of database. It's not even an interesting type of database. And it's not new, like at all. We're talking 70s. The innovation with Bitcoin was not blockchain, that had been around for a while, nor was it public-private key encryption, that had also been around for a while. Those were necessary inputs. The innovation was the game theory consensus mechanism. It was proof of work. It was how do we achieve consensus in a world of malicious actors with no centralized authority. That was the interesting innovation. The fact that a lot of banks and hospitals or whatnot are now considering using blockchain technology is great because they're basically using 30-year obsolete databases, so it's kind of an excuse for a general database upgrade. For example, thousands of people in the US every year die because hospitals don't share medical records. That's just crazy, it's just stupid. There's no reason, it's not a tech problem, it's a bureaucratic incentive problem. Similarly, for example, why, if you send an electronic check to someone in the US, it won't clear for 3 days. Why? It's just electronic. So many other countries, Brazil had same-day check clearing 25 years ago. So it's not a tech problem, it's a regulatory bureaucratic incentive problem. Sorry, my phone keeps locking me out. So the blockchain, I think there will be lots of great applications for it that will hopefully save some lives in hospitals, that will remove core to the back office of banks or more, that will enable way faster financial settlement and things like that. Those are great, those are meaningful, there will be businesses built around that. It's all incremental though. You're literally, for example, if you're replacing the back office of banks with blockchain tech, you are a database consultant, and that is the business model. And when I think about investing in those companies, that's how I think about them. So you could be very successful. There's plenty of great database consulting businesses. They tend not to be the most ambitious kind of companies. If you're an entrepreneur who's extremely ambitious, that's probably not the right place to look. But I mean, they will produce value, they will be meaningful. I think it's probably going to be a little crowded. So a lot of the traditional players like IBM have attacked blockchain. And so you're not necessarily doing anything new. Basically, the incumbents like IBM, I think, are probably well served to continue that role as database consultants in this new space. So now going even further, not only is it not blockchain, not Bitcoin, it's Bitcoin, not blockchain. So, I mean that further than it sounds. So a really interesting critical concept, and this is where I start getting a little bit controversial, where some of the other speakers might disagree with me, is Bitcoin is a financial asset. Usually, it's unfortunate that Satoshi used the same term for the network and the asset. So with Ethereum, you have the Ethereum network and Ether the asset. With Bitcoin, it's capital B network, small b asset. We're now starting to move Bitcoins on other protocols. So the same way I can transfer a US dollar by ACH, via Swift, via Cash, via PayPal, it's the same financial asset, it's different rails, different protocols. Bitcoin's the same. So I can transfer Bitcoin over to the Bitcoin network. I can also transfer it within a centralized database on Coinbase. I can transfer it via Lightning Network. And I think we're going to see a massive proliferation of protocols without their own tokens. So to me, this progresses logically from you can't optimize for everything. So a protocol is really limited by what it is. It's limited by its code. I won't get into the details, and probably earlier speakers today have talked about interoperability and atomic swaps, but there's a huge amount of cool technology that suggests, I think, that basically you will be able to get any feature in cryptocurrency produced anywhere on any other chain, with some limitations applying. So, in other words, it really isn't about the blockchain. It may be that in 10 years, 99% of all Bitcoin transactions are not occurring on the Bitcoin blockchain. They may be occurring on layer 2 and layer 3 solutions on side chains via interoperable swaps with other protocols. So I'm kind of I would heavily de-emphasize the static nature of the technology. If you become a master in kind of state-of-the-art blockchain as of 5 years ago, that's probably going to be totally obsolete within a couple years. The last personal note of kind of why I'm in this industry and what I think will also actually drive meaningful content. Dr. McCall just reminded me to ask questions, so I'll end on the sentence. I got into the industry because I had relatives who, some successfully, some unsuccessfully, fled Nazi Germany. The idea of having an asset, the original vision for Bitcoin was censorship resistant and seizure resistant, meaning a third party cannot take it from you by force or prevent you from transacting it. There's actually very few meaningful use cases for cryptocurrency that don't in some way connect to those two, because cryptocurrency is very likely to be inefficient and be more expensive than centralized alternatives. China just rolled out their social credit system. There's now 30 million people in China who can't board a bus because, for some of them, because they or relatives said something unfriendly about the government on social media, that dinged their credit score, they're now unable to get on a bus. That kind of thing is going to increase, so many countries around the world are moving towards more of a surveillance state. UK and Australia, for example, now have laws that it is illegal to have encryption that the government can't break. That's crazy but true. In Australia, you literally cannot provide an email service that without giving the government a backdoor. You will pay, I think it's something like $10 million a week in fines. It's outrageously, it's a punitive number. So one of the reasons I'm in the industry is I think cryptocurrency is an incredible tool as a last resort, a tool for the oppressed, a tool for refugees. Refugees are known to be impoverished and paupers, that's our stereotype. That's often because they have to leave everything behind. You have a lot of middle-class refugees who, at the border, are forced to leave all of their property. So I'm incredibly passionate and idealistic about what this industry can provide, but I'm also realistic about we have a long path to get there. Thank you. Yes?
Ari, you talked about everyone wanting to be a contrarian, but it's really hard. Can you talk through what it was like to be an investor in this space through the crypto winter of 2018? How did you manage your own confidence, your own emotions through that?
I actually thought about starting off my talk with a joke about something about like aging 5 years in a crazy bear market. Definitely a huge challenge, and actually when I was thinking about what to talk about, a key topic that I basically didn't get to was the craziness of not just really short market cycles and what that means, but business cycles. And the latter I hadn't thought about. So I was an investor trader. I spent a lot of time before launching Blocktower thinking about how do you want to heuristically, high level, think about your portfolio if you expect these crazy hyper volatile moves, but you know you can't time them perfectly. What I didn't think about before launching the firm was the non-investing side of that. So in 2017, late 2017, it was almost impossible to hire anyone, because everyone we looked at hiring, everyone who had any crypto experience or skill, so crypto traders were all too rich. If you were a crypto trader from early 2017 to October, and you didn't have $5 million, you weren't good. Not necessarily true of every investor or every developer, but if you were a trader and you started with 50 grand at the start of 2017 and you were good, you should have had millions at the end. That's how easy a market it was. So very hard to hire anyone on the trading side. On the tech side, everyone was looking at ICOs and saying, my friend just made my 25-year-old friend just made $10 million in 3 months. So I literally had a phone call with a very, very sharp 24-year-old engineer, and I said, what are you optimizing for? And he said, well, I basically want to work for the next 5 months, make a bunch of money, and then go to grad school. And he literally was hoping to make $5 million in the next 5 months. That was the kind of time frame I was dealing with as a recruiter. Today, it's the exact opposite. Everyone's laying off people, Consensus and Coinbase, and now I have my pick of the litter. I get called up by fund managers asking for jobs every week. It's something of a bloodbath, especially on the investment side. All those kids who started $5 million funds, the market fell 80%, so that 5 became 1. And then they underestimated the operational hassle, the expenses of operating a regulatory compliant business. I think the main takeaway I have is really expect that craziness and how do you deal with that. So with the market, there's no hedges. So I can take less exposure, cash is my hedge, but there are no value add hedges that I found at least, and I was an options trader, I look for this stuff. So you can't really hedge. You can change your position in the portfolio, but if you're going to be running 100% long, let's say, you just are exposed to an overnight gap risk. You are exposed to a sudden collapse. There's no way to mitigate that. You could be less long, but maybe your investors want you to be long. At the business level, though, you can do a lot. So you can set expectations with your investors, with your employees. You can structure comp with your employees in a way that incentivizes long-term commitment. So I would, for example, be very light on like a bad model would be, I'm going to pay my best investors and traders massive bonuses in up years and no bonuses in down years. Problem is they're all going to leave after the start of the bear market because now you're underwater, now they're unlikely to get comp, they're going to join something new. So you can think about incentives as, well, I gotta set the incentives to achieve what I want, which is I want these people to get fantastically rich with me, but I want it to be with a long-term commitment. With LPs, you try to manage expectations and say, we expect an 80% collapse in the market every few years. We expect that we're going to mess up the timing on some of them. Here's the plan, here's what you should expect. At a business level, a lot of cash in reserve. You can only fundraise when you don't want to. That's a painful thing, which I knew was true, but is like doubly true. So top of the market in 2017, investors were throwing money into crypto funds like crazy. 2 months ago, it was almost impossible to fundraise. Now it's getting easier again. And these are from astute, smart, value investors who think of themselves as contrarian, and they're not at all. No one is contrarian. Everyone, and by everyone I mean the family offices, the hedge funds, the sovereign wealth funds, they all invest high and panic when it's low, all. So how do you deal with that? You can't fix it. You have to raise the capital when you can. You then can leave it as cash. You have to be patient. I think it takes a lot of confidence in your opinion and your thoughts to ignore the voices around you. And I don't know if I have any great, I'll tell you the single thing I did for this, because I knew this would be a problem when I launched, which is it's going to be so hard to not care about monthly returns. It's going to be so hard to ignore the LPs who tell me to get levered long at the top and tell me to go heavily short at the bottom. And literally what I do is I put a chunk of my own money invested with us, and whenever I have any question about that conflict, I just say, what do I want to do with my money? Like, that's it. Like, I don't, period. That probably isn't the perfect approach from a business sense. Like, that might not grow my firm as fast as I possibly could, but it certainly removes a lot of mental stress over trying to throw that.
Well, is the Lightning Network too hyped up? Will it actually increase Bitcoin scalability, or what are your thoughts on the Lightning Network?
So the huge caveat is I'm not a technical expert. Elizabeth Stark, who runs Lightning Labs, is a official advisor to Blocktower and a friend, and she's awesome, and her firm is awesome. With that said, this stuff takes a long time. So Lightning Network at this point is not secure at all, and they will admit that. So it's a beta test. It should not be used with funds that you wouldn't want to lose. Very minor technical glitches are causing loss of funds. That is fixable. That will be fixed. At least the specific things I'm thinking about will be fixed. But I'm probably more of a pessimist just based on timeline. This stuff is, I think people are like, the passing of the torch was amazing. I think they had more than 10,000 people. So if you guys aren't familiar, the Lightning Network is a layer 2 built on Bitcoin, and the torch was basically just sending a single Lightning transaction past person to person to person, which included Jack Dorsey at Twitter, personally did it. It was like 10,000 people, which is amazing. So there's this huge community behind Lightning, very enthusiastic because they see it as the solution to Bitcoin scaling. I'm cautiously optimistic. I think we're going to see many competing L2s, which I hope optimize for different things. The idea that Lightning Network is around in 20 years is I would be skeptical of, because I think it's competing on features and tech becomes obsolete. So I view it as it's a feature of Bitcoin almost. And we'll have others and we'll have competing ones. I wouldn't expect anything fast. You go up there, sir.
We actually just stopped.
Oh,
and move on.
sorry. Thank you to the Penn Blockchain team for the wonderful event.